You sell your business, you work for years, and finally, there's a check on the table, almost $1 million. Your accountant says, perfect, let's pay you a capital dividend. It's completely tax free. That's the kind of news every business owner loves to hear. So, you sign the resolution, the paperwork looks clean, and over the next couple of years, you quietly receive the money. Then, one day, a letter from CRA lands in your mailbox. It says, the dividend you declared, it never actually existed. And just like that, a tax-free moment turns into a 7-year legal journey. This is the true story of Marc St-Pierre, a Quebec business owner whose routine corporate dividend eventually came before the tax code of Canada. Hi, I'm Amandeep Singh from Cloudriver CPAs in Burnaby, and our job is to help business owners navigate Canada's tax system the way Google Maps guides a driver, clearly, calmly, and without detours that lead to CRA trouble. Let's rewind to 2008. Marc owned a company called 2869-6474 Quebec Inc. He sold all the business assets, the equipment, the goodwill, everything for about $900,000. Now, when you sell business assets, part of that gain is taxable and part of it is not. The non-taxable portion goes into something called the Capital Dividend Account, or CDA in short form. It's not a bank account. It's a notional balance that tracks tax-free amounts like the non-taxable half of the capital gain or insurance proceeds. If your CDA has a balance, your corporation can pay that amount to you as a capital dividend, completely tax-free, but only if that balance truly exists on the day you declare it. Marc's advisors calculated the CDA and determined that there was a balance of about $596,000, which led to a resolution declaring a capital dividend in that amount. The resolution was signed, and over the next 2 years, Marc received several payments, roughly $86,000 in 2008, $381,000 in 2009, and $40,000 in 2010. Life moved on until 2011 when CRA reviewed the file and found something unexpected. The agency concluded that the CDA balance at the time of declaration was not $596,000, it was only $146,000. The difference, nearly $500,000, related to how timing rules were applied. Now, according to the tax code, the CDA had been calculated using professional tax software called Tax Prep 2008, which automatically added the non-taxable half of the goodwill gain into the CDA immediately after the sale. However, under the Income Tax Act, the non-taxable portion of a goodwill gain can only be included in the CDA on January 1st of the following year. So, even though the numbers appeared correct on the software, the CDA balance was not yet available in law at the time the dividend was declared. Everything looked fine on paper, but unfortunately, the statutory timing made all the difference. The court noted that the individuals involved were experienced professionals and that the issue arose from how the software handled the timing of eligible capital property dispositions. The CRA also acknowledged that this was an involuntary situation, not one involving intent. At Cloudriver CPAs, we view this as a valuable lesson in process. Before any capital dividend election leaves our office, it goes through a capital dividend election routing form, which is a built-in checklist that asks, has another CPA manually verified the CDA numbers and timing? Does the resolution dates and payment dates align? Is CRA authorization in place if the balance needs to be confirmed? And has the election been filed to the correct tax center with documentation attached. Every step is verified before funds are moved because once the dividend is declared, it cannot be undone without a formal court order. That's why we say precision before payment because CRA does not provide retroactive corrections. After the CRA identified the timing issue, Marc's corporation sought administrative relief. A proposal was made to amend the dividend amount and redeclare it in a later year, but the CRA unfortunately declined, explaining that such adjustments were not permitted once the election had been filed. You see, the only remaining option was to ask the court to cancel the resolution itself. In 2013, Marc applied to the Superior Court of Quebec, and in 2014, that court declared the 2008 dividend null and deemed never to have existed. It also ordered repayments of the amounts that had been distributed. Following that decision, Marc reimbursed his company approximately $596,000 along with interest. However, CRA later determined that the funds he had received earlier were taxable as a shareholder loan under Section 15 with additional interest benefits under Section 80.4. Marc argued that no debt existed until the Superior Court decision in 2014. But the tax court held that once the dividend was retroactively nullified, the amounts he had received were considered to have been received without entitlement, effectively creating a shareholder debt, unfortunately, from the outset. Justice Real Favreau emphasized that while the circumstances were unintentional, the statute required those amounts to be included in income. The reassessment therefore remained valid. Marc later repaid approximately $539,000 and in 2015 declared a new capital dividend for $540,000, this time supported by the corrected CDA balance and dates. It had taken nearly 7 years and 2 separate court processes to resolve what began as a timing discrepancy. So, what can business owners learn from this? First, confirm your CDA balance. It's not a legislative requirement, but obtaining written confirmation from CRA before declaring a large capital dividend can prevent misunderstandings later. Second, check your timing. If goodwill or eligible capital property is involved, the CDA addition starts the next January 1st. That's because the non-taxable half of your goodwill gain is determined at the end of your fiscal year and legally enters the CDA on the first day of the following year, not on the date of the sale. Declaring a dividend too early means you might be drawing from a balance that does not yet exist in CRA's eyes. Third, use a review process before filing Form T2054. A second reviewer or a checklist can make sure the dates, numbers, and filing locations are all properly aligned. And finally, if a dividend ever needs to be reversed, ensure repayment occurs promptly, since outstanding shareholder debts may become taxable under Section 15 of the Income Tax Act. Marc St-Pierre's case illustrates how the court interprets timing and entitlement under Canada's tax rules. It also shows that even routine corporate transactions benefit from thorough documentation and review. At Cloutier CPAs in Burnaby, our focus is on helping businesses owners stay compliant and confident, ensuring that when you declare a capital dividend, it remains exactly what it was meant to be, tax-free. I'm Amandeep Singh. Thanks for watching this video and I'll see you in my next video. Until then, bye.